Hey everyone. I know some of you investors are starting out with relatively smaller investment amounts and thinking, what stocks can I buy with less than $100? Some of these high-flying stocks like Nvidia are trading close to $1,000 per share. Nvidia, Supermicro, these hot AI stocks might be out of reach for some of the investors that don't have that much money and they don't have access to a platform that sells fractional shares. So the good news is I've got one stock for you today that's trading at less than $100 per share. In fact, it's less than $75 per share as of this recording that I think makes an excellent buy today. I'll share with you what the company is and what makes it such a good investment for investors at this price.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock I'm talking about in this video is Uber. Uber Technologies is trading at just $74 per share. Now, I know the stock price has exploded higher, but I still think it's a great value. In fact, I have Uber on my list of top 25 stocks to buy in 2024. I put that on my list around December 30th. So if you bought it then, you would have made some nice gains on Uber stock. Still, I don't think it's too late to capitalize on Uber's excellent progress. Let me share with you some of its key characteristics. So in Uber's latest quarter, which ended December 31st, its monthly active platform customers increased by 19 million from 131 million to 150 million. That was a 15% increase. The number of trips taken on the platform increased by 24%. So what this means, if only 15% increase in monthly active platform customers and 24% increase in trips means each customer is taking more trips, more engagement on the platform, and that's really good news. Gross bookings, which measures how much customers are spending on the platform, not necessarily what Uber takes in revenue, because Uber has to share some of that money with drivers and restaurants and providers, that increased by 22%. Uber's revenue specifically increased by 15%, and more importantly, its income from operations turned profitable to 652 million, up from being negative 142 million. Net income was up even more than that to 1.4 billion, and cash flow provided by operations up to 823 million from negative 244 million, and free cash flow up to 768 million from negative 303 million. So all these vital metrics turning positive and increasing at a rapid rate as Uber surprised me in 2023 and 2024. I was under the impression that when restaurants reopened, people would be ordering Uber Eats a lot less often, but its delivery business has done well, and the trips business, the mobility business, the ride sharing business has absolutely thrived. More and more people are using Uber to take trips, and that's resulting in greater revenue and greater profitability for Uber. To my surprise, considering how expensive it's been, how much the prices have increased, and customers have stuck around. That's what I was waiting for Uber. For the longest time, I did not have Uber rated as a buy, all the way until sometime mid last year is when I decided to upgrade Uber stock because it demonstrated the ability to raise price and keep customers. I didn't know if it was going to be able to do that. This whole time I was telling investors, I want to wait and see if Uber can raise price high enough to where it can generate profit and still keep customers. And it proved that, right? So far it's proving that. Now, we don't know how long it's going to sustain, but so far it looks like it is sustainable. And given the cost of substitute, I think Uber can sustain this because for many people, even though every Uber trip is getting more and more pricey, when you compare it to car ownership, it's becoming relatively more attractive now because the price of car ownership has increased so much. Insurance costs are higher, maintenance costs are so much higher, the car payment, the car itself is so much more expensive, fuel prices are so much more expensive, etc., etc. So switching over and saying, you know what, let me go with Uber makes a lot more sense for a lot of people, especially now that remote work is more prevalent. If you don't need a car every single day, If you only need a car to go to work 3 days a week, then it's especially more attractive to stay with Uber than to go with purchasing a vehicle. It's a lot more convenient. And I can understand why people are choosing Uber more often, even though the prices are higher. Relatively speaking, the price isn't that much higher, and it's a lot more convenient. So it's interesting, and the company has definitely proven itself with customers. So here you get a nice picture of the company's latest quarter and its 3 business segments. It's mostly mobility and delivery. The freight business, they're kind of divesting away from that. They're not focusing on that segment anymore. Mobility is the ride sharing, and you can see that increased by 34% year over year to 5.5 billion. And the delivery business increased by 6% year over year to 3.1 billion. And in fact, if we were to compare this like for like, the delivery business increased by even more than that. There was a slight change in the way they accounted for incentives. So previously, when they sold you a Uber delivery and they gave you one of those coupons, I know you've gotten them. I've been getting them all year, where they say 20% off your next 3 orders of $25 or more. They used to account for that as a marketing expense, but now they changed that as contra revenue. What that means is it's going to decrease the revenue. Instead of Uber saying, okay, we got $100 in revenue and $20 in marketing expense, now they changed that to just say we got $80 in revenue. Does that make sense? So they changed it. Instead of it being 2 separate line items, the incentive that they send you has now come off of the revenue. So now they just report the revenue. So that makes the revenue growth look a lot smaller than it actually was. If you look at it like for like, revenue growth was much better. And that surprised me. I thought the delivery business would decline when restaurants reopened. Remember 2022? We had a lot more of closures, and we had, mostly 2021, you could say, we had a lot more restaurant closures because of COVID, and people were ordering for home delivery more often. Well, that business has sustained. Surprisingly, it's sustained really well. I thought it would decrease, but it hasn't. People like the convenience and they keep ordering for delivery. Now, if you look at it on a percentage basis, let's say you order a $30 meal and Uber charges you $10 in fees for that delivery, you might say, man, 33% fees, that's a lot. But then when you look at it at just $10, then that makes it a lot more convenient, right? When you think about, like in my city, I live in Los Angeles, just to go down the street to pick up something, it could take me 30 minutes. The lines, the traffic, looking for parking, all of that hassle, sometimes I might choose to go with Uber, even if it costs me 33% to order, because the absolute value, it might just be $5 or $6. And if it's going to save me 30 minutes of my time and the hassle and the inconvenience of going out in traffic, looking for parking and all of that stuff, I might just say, all right, you know what? Let's go with that $5, $6, $7 fee. It's worth it. So Uber's convenience advantage is really paying off, especially in larger cities where it's very inconvenient to go down the street to pick up a meal, to park and go inside and get your meal, or whatever that use case might be. Uber is finding more and more situations where it's worthwhile for customers. And so because of its success, Uber's 3-year outlook the management gave us on their investor day was robust. They forecast that they're going to grow their gross bookings at mid to high teens compounded annual growth rate. So mid to high teens means it's going to be something like 16, 17, 18%, something around that range, 19% perhaps, okay? So mid-teens is 14%, 15%, 16%. High teens is 17%, 18%, 19%. So they're telling us mid to high teens. So you could chop off the bottom part of the 14 and you could say, well, somewhere between 15 to 19% compound annual growth rate for gross bookings. That's robust, that's solid. And then adjusted EBITDA, even better, high 30s to 40% compound annual growth rate. And free cash flow is expected to be 90% of adjusted EBITDA. So as adjusted EBITDA is going to grow, so is its free cash flow. They're going to be closely connected, more than 90% correlated. Robust forecasts from Uber, because they've seen such strong results, they're confident that their business continues to thrive going forward. And you're getting all of this at a relatively cheap valuation. You're paying a forward price to earnings of 23.93 for Uber stock, all of which I think is a great value. That's why I have Uber on my list of top 25 stocks to buy for 2024. I like its prospects and I like the valuation. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.